2025 started like an okay year for the stock market. However, these past few months have been intense, filled with uncertainty and huge market swings, especially going to the downside as we can see in the graph. It has not been rare to have days with the stock market being down over 6% and days with the stock market rallying up another 6%. All because of some trade wars and some tariff disputes that are going on between Donald Trump and China. However, when I find myself in situations like this one, when it's very difficult to actually grasp anything positive about this, I like to try and embrace it, learn, and adapt so that the next time that an uncertain period like this one comes around, I'm better prepared. So these circumstances have actually allowed me to be critical of my portfolio, find those stocks which I'm the least comfortable actually holding or investing whenever they're 10-15% down, and overall just rethink my overall long-term strategy. And just to be completely transparent, this is the most noticeable performance from some of my holdings, only showing this 1 month return. With Uber being one of the few positive holdings for this time period, outperforming the market mainly because the tariffs are negatively impacting the automobile industry, meaning that the prices for new vehicles will actually rise heavily, and the market has actually perceived this as a positive thing for Uber because it means that a lot more people will have to delay their vehicle purchases, which means that probably a lot more people will have to use Uber as a service. Now, I'm not exactly sure that that's the impact that tariffs will have on Uber, but I do believe that Uber was trading at a pretty low valuation before all of the tariff situation went around, so it does make sense that the share has not fallen significantly and has pretty much stayed stable. We also have Booking, which is only down around 0.4%. When we look at S&P Global, this company has actually been hurt, and Google as well, down over 7.7%. In the case of Google, it's mainly because there have been advancements in the antitrust lawsuits that it's facing, and in one of them they've actually found evidence declaring that it is running a monopoly on the advertising segment of its business, which is the most profitable and the main thing that makes Google Google. And last but not least, my worst performer has been Crocs, and this is very simple to understand. This is a company which has mainly been growing because of the Southeast Asian market, in particular China. So all these tariffs are having a significant impact on this company because it means that all their prices will be raised considerably, which means that a lot of Chinese consumers will just stop spending or purchasing Crocs, which, as can be seen, affects their business very heavily. But now one thing that this market downturn has actually made me realize is that when I'm older and when I have more responsibilities, maybe even kids, I would not be able to manage the stress of my whole stock picking portfolio being down 30, 40, or even 50%. As we can see over here, this is the maximum drawdown by year for the S&P 500, and there are over 10 times when the whole market has been down by over 30% from its highs. If you invested in 2007, you would have seen your whole portfolio being down over half. Well, right now that I can actually withstand that, I believe I would be alright. Of course, I would be stressing, but I would survive. In the moment that I have some responsibilities, I'm not entirely sure that if my whole net worth is allocated in a portfolio which can be down over 50%, that I would actually feel comfortable. So what I have decided is to create a new portfolio with the whole purpose of diversifying and minimizing my personal maximum drawdown by year. Now, this doesn't mean that I will stop stock picking. I love doing that and I think it's extremely insightful and very interesting. However, I believe that by creating and investing in this new portfolio, I'll be able to continue my stock picking journey without suffering and stressing as much when the stock market is actually going through hard times like it currently is. And believe me, I am aware that this is not one of those very bad times. The stock market is down only 10 or 15%. There are times when it has gone 2 times, 3 times, or even 4 times lower than what it is right now. So I'm just preparing for when those times actually do come around. And my whole purpose while building this new portfolio is to reduce my volatility, my maximum drawdown, and my risk, improving and actually generating a better risk-adjusted return, or as we can see in the graph, getting a similar return than I was facing previously. Because as Benjamin Graham actually stated, The essence of investment management is the management of risks, not the management of returns. So over this past month, I have been researching and building a safer, longer-term automated portfolio. I have been considering only investing in an ETF following stocks. I have been considering the 70-30, 50-50, and different blends with bonds. Of course, the closer you go to bonds, the lower expected returns you will have, but the lower or the better your worst year will be. However, as you may know, I'm a very big fan of one specific portfolio, which is the all-weather portfolio. And just to show over here a comparison between the all-weather portfolio and the S&P 500, well, the all-weather portfolio obviously has lower returns with a 7% annual return versus a 10%. However, it actually beats the S&P 500 in terms of risk-adjusted return because the maximum drawdown for the all-weather portfolio is only 17%, while the maximum drawdown for the S&P 500 is 50%. And in order to create my portfolio, I took the composition of the all-weather portfolio and I adjusted it more to my risk profile and my current belief of the economy. For example, the commodity segment, which represents a 7.5% of the whole portfolio, I have actually removed and I have expanded my allocation to gold, which instead of 7.5% goes all the way up to 20% holding. And when it comes to the allocation to bonds and stocks, I have increased my allocation to stocks and I have decreased my allocation to bonds, mainly because I have a higher risk profile, and even though I want this to have a lower volatility, I still want it to have an alright performance. So the portfolio that I'm starting has this composition. It is made out of 55% stocks, which is represented by the All Country World Index. Then it has a 20% of gold and a 12.5% of long-term bonds and a 12.5% of short/midterm bonds. Now, one of the main tools that I used in order to reach this new allocation was backtesting. The way that this works is that it simulates your portfolio actually running for the past 20 or so years. It gives you all the values like the performance, the standard deviation, and the volatility, and then you can compare that with any other portfolio that you want to build. Additionally, you can adjust your allocations to maximize either your return, minimize your risk, or just maximize the Sharpe ratio. When comparing this long-term ETF portfolio to the all-weather portfolio, we beat it in returns from a 7 to a 9%, and we actually lowered the maximum drawdown from a 17% to a 16%. Now, when doing this, you have to remember that past performance is not an indicator of future results, but it does give you some sort of security that you're doing the right things, especially if you have conviction on where the economy is heading and you actually tailor your positions to what you actually believe. And just to compare the three asset classes that I will be holding, we have stocks, bonds, and gold, which actually go from higher potential returns to lower, and from a higher risk level to a lower risk level. The best period for stocks is a period of economic growth. Now for bonds, it's a recession or when interest rates are lower, and for gold, it's a recession and when there is high inflation. Now, when there is high inflation, stocks perform well and bad. It depends on which sector, which segment, and which type of stock you're actually invested in. Bonds actually underperform, and gold, as we have recently seen, actually overperforms. And just for factors that move the price of these asset classes, when it comes to stocks, their prices are moved via corporate earnings. If they're good, the price will rise. If they're bad, the price will actually decrease. And by also market sentiment. If consumer confidence is high, then there will be a general appreciation of all stock prices. Now bonds, they basically move because of interest rates and because of the different situation regarding credit risk. And now when we talk about gold, basically global demand, uncertainty, and inflation are the three main components that drive the price of this asset. And lastly, I also define my long-term investing strategy, which is built around monthly automated contributions in order to remove emotions from this process. These contributions will be done following the defined allocations. So it means that every time that there is an investment done, it will be divided in the same way, 55% to stocks, 25% to bonds, and 20% to gold. There is a possibility that I'm balancing for a year rebalancing. I will do a video about this because there are a lot of studies showing that actually rebalancing improves your performance, and there are a lot of studies showing that rebalancing actually hurts your performance. So it is something that I still have to look into, however I am balancing this possibility. My objective is to not sell anything inside this portfolio until retirement. I will try to have an emergency fund ready, and if anything goes wrong, I will prioritize removing my investments from my lowest conviction stocks in the stock picking portfolio. And finally, there will be a monthly review in case I want to add any ETFs or I want to remove any ETFs. And now, as I've stated before, this does not mean that I will be forgetting my stock picking portfolio. This will be a highly automated portfolio that will be on the side, and it will just provide me with safety or with more certainty whenever there are tough times like right now. I will of course continue reading the annual report of my holdings, looking for new investments, and giving you the best content in order for you to develop a solid portfolio. So as always, thank you for watching. This has been the Cashflow Compounder. Join the free Patreon for extra content, and I will see you in the next one.